Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, I'm really anticipating this. She doesn't write it out like Cam Dawson joins us from NewEdge this morning. You don't do an outlook, do you?
Oh, we do an outlook, but we publish it in January, so we get to look at everybody else's outlooks, see where consensus sits, and then make our forecasts.
Smart.
Okay, so, I guess, what do you see?
Well, we see a lot of bullishness. You have an environment now where there's not a single strategist on the street that is expecting a down year in 2026. Certainly that is a shift from the last couple of years where you had some stragglers of bearishness left over after 2022's weak environment. But we are in an environment where you're still seeing GDP forecasts continue to get revised higher. You're seeing EPS forecasts continue to get revised higher. And the biggest challenge you have is that valuations are already pricing in a lot of good news. So when you look at consensus, they're expecting valuations to hold steady and earnings to deliver.
Yep.
That does create somewhat of a high bar for big, huge returns in 2026.
I'm trying to figure out what is the black swan out there that could really crack this market, because valuations are high, but I know that high valuations historically do not push markets lower. It's usually an event out there that says people to look at the market and say, boy, this is rich, and given what just happened, maybe we should take some money off the table. Valuation
is a very poor timing tool. It has no predictive power on 1 year forward returns, but it does have predictive power once you start looking out 3, 4, and 5 years. So you're at an environment or at a point where you can say we shouldn't be surprised if forward returns are lower over the next 3 to 5 years than they were over the last 5 years, where they have been extraordinarily strong. As far as catalysts go, valuations are really interesting because it's like that old Warren Buffett phrase of price is what you pay and value is what you get. Usually the difference between price and value is a certain degree of emotion, meaning there's a certain degree of hope and dream within valuations. And so if you were to knock something like the AI trade and all of that optimism, could that be something that sees a broader catalyst as an unwind to overall valuations? It's a good watch item for 26.
Technology, AI, have been the driver of this market for several years now. Can we expect that to be the case in 26?
It all depends on earnings. Yep. One of the reasons why we have seen such a powerful degree of outperformance and narrowness of the market is because earnings have been narrow. The most startling stat is that over the last 3 years, you've seen the Mag 7 grow earnings by 200%, but the equal weight has only grown earnings by 16%.
Brilliant. Thank you so much for bringing this up. I thought Barron's did a great job this weekend. Besides the 4 ads for Cam Dawson and Barron's, I thought that Barron's did a great job parsing this. This is something Gino Martin Adams really would push as well. So why is it end now? I just heard you model out, in a cautious strategy-like way, single-digit performance next year. It's not going to be as good. What's a WEI go? Paul taught me this function.
Sure.
WEI, we're up 16% SPX, NASDAQ comp up 20%. So you model out single digit, and like you say, we've gotten it wrong for 3 years.
Yeah.
Why now?
Why now? I think that there's a lot of expectation that you're going to see a deceleration in Mag 7 and an acceleration in everything else. And that has been an area where there's been a lot of surprise. So the reason why Mag 7 has performed so well is because it keeps surprising to the upside. And then the reason why equal weight has been so weak is it keeps surprising to the downside. So I think that in order for this to be something more than just a flash in the pan rotation, you have to see those earnings deliver.
I was on the phone with Michael Barr this weekend as he was losing the house on the Detroit Lions. And Paul, I said, I got to look up the date, January 13th of next year.
Yep.
Which is not that far away. No. JP Morgan earnings.
Yeah.
We're going to, the belief of the bulls, futures up 31. Paul, we're going to do it again.
Yes.
Worry, angst, OMG, we're 3-4 weeks away. JP Morgan, January 13th. Hello.
Are there some sectors, Cameron, that maybe screen well for you these days outside of technology? I mean, I'm sure people come up to you and say, I'm long tech. I get it. But where else should I be looking?
Yeah, Yeah, there has been this dynamic that you might call inattentive blindness. The idea because people have been focused on just one thing, which has been AI and tech. There was a lot of good things happening outside of just those areas. So look at some of the strength that we've seen in some healthcare names, look at some of the strength that we're seeing in some of the materials. But here's the question. Do you buy things that are oversold in uptrends, like a tech? Or do you buy something that is overbought in a downtrend like a healthcare, betting on a more sustainable trend change?
Yeah, this is really well said. Which one do you tilt to in terms of optimum outcome out 12 months, 18 months, 3 years out?
I think the prudent thing to do is make sure that you start to get closer to neutral. And that is the least exciting answer that we can give. But most people, given the run that we've had, are very overweight tech.
I thought it was a really rich weekend. There was a lot of intellectual work out there. Cam Dawson with us, speaking of quality effort, NewEdge Wealth, thrilled that she could be with us here to get us started strong. A whole bunch of other people coming up today as well. Eric Belchunas on ETFs. Alessio de Longis hasn't been in ages. He'll be in here the 8 o'clock hour. Paul and Monica killed it this weekend looking at ETFs and factor ETFs. I think of you. I think of Liz Ann Saunders and other strategists, Brian Levitt over at Invesco. Factors are everything. Does it make sense to bet on momentum? Does it make sense, as LaMonica brilliantly said, to bet on revenue is a factor?
Factor ETFs have been incredibly disappointing this year. Oh, really? If you look at things like quality factor ETFs, and there's a lot of different ways to define quality.
Yeah.
All of those ETFs have substantially underperformed the market. And of course, we can look to things and say, oh, well, it's just concentration in Mag 7 and the leadership is so narrow. But there seems to be a need to rethink some of the way that these ETFs are constructed, potentially making them a bit more intelligent in how they define those factors, because we've been looking at those factor ETFs going, gosh, this performance is extraordinarily disappointing.
This morning, to get you started for a busy week, Cameron Dawson with this NewEdge Wealth Management. Good morning across the nation, the way you listen to us, and good morning on YouTube. Subscribe to Bloomberg Podcasts. We're finishing the year strong with Bloomberg Podcasts on YouTube. Please subscribe. You go out there, you search for Paul Sweeney, and then you go, yes, folks, somebody just emailed him. We'll talk to Sweeney about the ski conditions. I promise we'll get to that. But on YouTube, subscribe to Bloomberg Podcasts.
Cameron, in the fixed income market, I'm looking at the IN-GO function on the Bloomberg terminal, the Bloomberg index browser. Boy, fixed income, high single-digit returns in 2025 across the board.
Like 60-40 worked this year.
Yeah, it certainly did. So what are we thinking about the fixed income market in 26?
Yeah, we wouldn't be surprised if you continue to see this volatility within fixed income. Remember, we came into the year with somewhat higher yields, and so there was room for downside. But if we continue to chop around in this range for yields, it means that maybe the best of the return that we get is just the coupon, which suggests that maybe not the most exciting returns. But I think that the key point is that we do expect fixed income to play its role in 60-40 if we were to see a weaker growth environment in 2026, meaning that we don't think we're going to see at this time a big surge in inflation, which means that fixed income can be a hedge within portfolios if growth were to weaken.
Your charm is you have been invested through thick and thin. The successful strategists say you have to participate. There's a debate about how you participate, but you participate. So I'm looking here. I went back and looked, Paul, early April. Yep. The world was going to end for Apple. They were done. They were finished. Mr. Cook was a failure. All that. Paul taught me this, folks. The description screen in the Bloomberg, Apple, 12 months return up 13% and up a gajillion percent from the bottom in April. How do our listeners and viewers use strategy to avoid the fears that we saw in early April of Apple?
I love the concept of fear. As an emotion in an individual, it can be incredibly blinding. However, if you can measure fear in aggregate, it is the most illuminating thing possible, meaning that if we can see when everybody else is afraid, it shows you when forward returns are getting better. So we measure things that capture fear, like the percentage of names making new 20-day lows, or things like overall breadth within markets, put call ratios, ideas that when you see fear spike, even though it feels terrible to be allocating capital to markets, it usually is a time where forward returns are improving substantially. So we measure fear as a way to keep us from making poor decisions, which tend to happen at those times.
Apple off the bottom. Sorry to interrupt,
Yeah.
Paul. Apple off the bottom in the spring. The world's going to end up 70%.
Look at that. Cam, we've seen retail investors come in and buy the dips. What dips we've had, we haven't had too many dips, but when there's a dip, the retail's come in and bought. What does that tell you out there? I mean, you talk to a lot of these folks.
Yeah, there's a lot of appetite to continue to allocate to stocks, and you can see it. FINRA margin loan balances have been jumping out to us, growing 40% over the last 6 months. And I think the contrast between the retail investor who has been buying dips and the institutional investor who hasn't. Because ever since the April low, you actually have seen institutional investors, based on the Deutsche Bank survey, not even get back to overweight. So it means that a large cohort of this investor, yes, they've been buying some, but not to the degree that you would expect that you would normally see given the strength we've seen in markets. So retail investors have been right, and institutional investors have been more on the sidelines.
What are we doing here with gold? I mean, I think we're hitting a new record again today here. I mean, do your clients ask you about gold a lot?
Yeah, all the time.
All the time.
All the time. Look, we call gold a psychological commodity because it allows you to get some kind of comfort with things like fears about currency debasement. But the technicals are the technicals. The uptrend is still very much intact. It is incredibly overbought on a weekly basis, meaning it's moved up very far, very fast. But we've been calling gold Chuck Norris, which means that it's just been invincible and nothing can hurt it. The trend is really powerful, but keep an eye on the technicals. Right. The narratives will remain, but gold could go into a consolidation.
Lisa, should we have gold called the Rock? That would work out.
Yes,
we could
I would
have
like
the Rock
that.
and
Yes.
Chuck Norris. I can see that as well. Is there a legit commodity boom? I noticed with gold, oil not participating, but I'm sorry, there's a legit commodity boom. Is that an expectation out front of a recovering Asia?
Yeah, a bone to pick, because everybody looks at the BCOM index, the Bloomberg commodity index, and say, look how we're in a commodity boom. A lot of that is gold. Look at the BCOM industrial commodities index. You're seeing some movement higher in that.
Yeah, I know. I didn't even know we had that.
Stop the show.
It's
Rich, stop the
BCOM-IN
clock on the show.
is the ticker. But
yeah.
it's important to see that you
you're
have
right.
seen some movement higher. However, it's certainly not breaking out nearly to the extent that the BCOM benefiting from gold has.
See?
What's the symbol? I got
I got BCOM. I can do that.
BCOM-IN.
Jeez.
BCOM.
Every day's a school day.
Every day's a school day. There you go.
She was the girl in class
Yeah.
you hated.
Sitting in the front row every time.
Okay.
Oh, that's it. The Bloomberg. All right. I got you.
I'm glad somebody's got you.
I got you. I mean, 50. Yeah. All right. I mean, commodities have just been ripping it. So there you go. We learned something.
I still can't look it up.
That's all right.
Oh, Tom Secunda's on line 2. Excuse me. We'll get to. Would you write that down, please?
Yeah, sure.
What is this, a terminal seminar?
I know.
Cam Dawson can start giving a terminal seminar. Cam, thank you. Thank you so much. Greatly appreciate you coming in. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Alessio de Longis, he is head of asset allocation at Invesco, joining us live here in our Bloomberg Interactive Broker studio. Alessio, I mean, no matter where I allocated money in 2025, I did pretty well. Stocks up double digits, bonds up high single digits. Commodities through the roof if you're long gold or silver or any of that type of stuff. What's the 2026 outlook as you think about where to allocate money these days?
Good morning. Yes, you summarized 2025 perfectly, right? We only a couple of years ago, we were talking about the death of the 60-40, and here we are, the 60-40 is back. 2026, we expect still an environment where you need to be long risk assets. Let's keep it simple. We have easing of monetary policy, expansionary fiscal policy, and inflation is in check, above the Fed target, but is coming down. That is a mini Goldilocks scenario, right? Where typically assets do very well. Growth, not too hot, not too cold, keep the risk on. Now, AI technology is, of course, the the risky part of the market in terms of the outcomes. The uncertainty is widening with respect to the certainty of that payout. We have excessive capex spending. Expected earnings growth is now the lowest in 4 years. So for us, the safest way to stay invested is to rotate into value, into mid caps and international markets.
Is there such a thing as tech value?
Actually, the Mag 7, when you compare it to the other pockets of tech, is where the valuations, yes, at 26 PE, the Nasdaq today is excessive, but is nothing like the 80
so
PE
buying
that we saw.
Apple is like buying international paper 20 years ago.
It's a good analogy, but the point is this is really an environment where we're beginning to see the long-awaited broadening out of participation. You see it also in earnings revisions. For the first time now, over the last 12 months, we're beginning to see earnings revisions in developed markets outside of the US and emerging markets turning positive on a 12-month forward basis. So we're beginning to see that convergence. So in our opinion, there is going to be convergence in the performance of equity sectors and styles, and also between regions. So staying allocated overweight equities, underweight fixed income, and maintaining a neutral duration posture. We are not concerned about debt, about yields in the U.S.
Okay. So U.S. versus non-U.S., how should we think about that? If I want to go outside the U.S., am I looking at developed markets, emerging markets? I've heard a lot more discussion about emerging markets over the past 6 and 9 months than I have in a while.
We find the case for both, with emerging markets probably leading the charge between the two. What are the drivers here? We continue to see, with high conviction, an environment of dollar depreciation. Dollar depreciation will favor international markets broadly, but with emerging markets in particular, there is a re-rating of fundamentals, because as the dollar goes down, the level of liabilities for these markets, as they're mostly dollar liabilities, goes down. So boost from a currency perspective and boost from a fundamental perspective. So we like emerging market equities, we like emerging markets local debt, and emerging markets hard currency debt.
Alessio de Longis with us. He is with Invesco as we talk about these markets. The markets lift this morning. Just a quick data check here. Futures up 32. The VIX is a 16 level. Paul and I noting 57 handle on American oil. And Brent was $60 a barrel, now $61 a barrel, down fractionally. Gold, a moonshot, up $42. 4371. Wow. On gold. Paul Sweeney with Alessio.
The dollar has not bounced back like we saw the stock market bounce back, and some other asset classes bounce back from the tariff-induced sell-off earlier in the year. Why do you think the dollar was the dollar just maybe overbought earlier in the year, or is this something more fundamental?
I think you're highlighting to me the most fascinating decoupling in asset performance that happened this year, to your point. It's indicative, when we had the tariff scare and the big, beautiful bill, fiscal expansion, the concern around debt sustainability for the U.S., the path of least resistance to finance excess spending is a weaker dollar rather than rising bond yields, right? So it is indicative of the euro, the yen, and many of these currencies still being cheap relative to the dollar. By our valuation metrics, 130 on the euro is not an aggressive call. Let's not forget that the euro was at 140 in the midst of the European debt crisis.
Can I do an audible?
Sure.
Got to do an audible. Alessio de Longis as well. What's amazing to me is in many frameworks, Italy is in better shape than France. Well, the first time I met you was an Aperol Spritz on the 7th floor terrace at the Hassler. Okay, help me here. Is it France is doing poor, or is Italy finally getting its act together?
There has been a convergence. Italy has been benefiting tremendously from the COVID support, the fiscal package from the European Union following the COVID support. The money is being well spent and directed to the appropriate sectors of the economy. And France, just to pick one, as you mentioned, has seen some more headwinds to its structural challenges. So the convergence is real. Italy's been performing well. The challenge will be, will the private sector sustain that rebound that was induced by public spending?
Alessio, thank you so much. Alessio de Longis with us here, with Invesco here. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Good time to end the year here with Campbell Harvey. He's definitive at Duke University, thinking about the broader perspective of technology across the centuries, across the decades, and into the future. Professor Harvey, thank you so much for joining. I want to get one question in here before Paul talks Duke football. but Cam, I look at the innovation. Is the innovation we're talking about now, is it the innovation of our academics of decades ago, or is it a new innovation?
There's fundamental innovation and there's applied innovation. If you look at the actual productivity of kind of university-based innovation, you can argue that it has decreased since the heyday of the 1960s and 70s, but more than made up for in terms of what's happening with corporations. Indeed, it's an extraordinary amount of R&D that the U.S. is spending, and it dwarfs, for example, the EU. So we spend far more on R&D than the EU, even though the EU has a greater population. And it's no surprise that 17 of the largest 20 companies in the world are based in the U.S. Indeed, we have companies that spend more on R&D than countries like France and Italy.
So, Cam, as you think about some of the money that's being spent on AI, I mean, the dollar amounts, the total sums are just extraordinary, like we've never seen in any other industry, I think. Is there any way to gauge whether this is money well spent, or is it just kind of too early in the process?
Yeah, there's lots of comparisons. Indeed, what's being spent today is, if we look at it in a relative basis, not as much as what was spent on the railroads in the mid 1800s. So we need to be careful because there's not that many historical episodes. And it is just so tempting to say, oh, well, what's happening in 2025 and 2026 very much looks like 1999 and 2000. I fundamentally disagree with that.
Cam, one of the issues that we've seen in the marketplace is, I think, got some people scratching their head a little bit, is the U.S. dollar here. We've seen the stock market bounce back, seen a lot of commodities hitting all-time high, but the dollar seems a little bit unloved here. Is that just a function of the dollar maybe was overbought at the beginning of the year, or there's something fundamental going on here?
Yeah, exactly. I think there is noise. So we do get fluctuations that aren't necessarily explained by fundamentals. And I think it's really important to look at the dollar in a longer term perspective. So not just this year or post-Liberation Day. Look at the dollar over the last 5 or 10 years to get a perspective. So there is fluctuation. It has been beaten up mainly because of the chaotic nature of the tariff initiative. And I do think that in 2026, the tariff initiative will not be as chaotic. It'll be more strategic.
Right. But is the tariff thing that I'm surprised people are talking less about, is it a germane issue just within almost the microeconomics of GDP? I mean, I'm hearing too many people telling me tariffs aren't affecting it. And people that I know that are struggled are saying, Cam, you're out of your mind. Tariffs are a huge impact. Which way is it, Professor?
So I was on this show around Liberation Day, and in many other outlets, it was not a very popular thing to say, but I said that the tariffs were not necessarily a big deal. And the math is really simple. The size of the U.S. imports is small, like our exports. So imports are at best 14% of GDP. The exports are, let's say, 11%. This is a very small amount of our economy, but it was really overblown, in my opinion. So again, I think that in 2026, it will be more strategic. Let me give you an example of strategic. So most people hear about China dominating the rare earths with over 90% of world production. But most people don't realize the state of aluminum production. So aluminum is a strategic metal. So this is important in aircraft and other applications. So it turns out that China produces 60% of the world's aluminum. And what about the US? The US is less than 1%. So this is a microcosm of what's happened in the US. So in 20 years ago, the US manufacturing was approximately double that of China. And today, China manufactures 60% more than the US.
Wow.
So again, I think in 2026, whatever tariffs will be more strategic, focused on repatriating some manufacturing that is strategically important to the U.S.
Cam, before we let you go, we got to talk to you about gold versus Bitcoin. Do we talk about them in the same sentence these days? Are they both stores of value? I don't know. What's your latest thinking?
Yeah, my latest is a new paper called Gold and Bitcoin. And I argue in that paper that Bitcoin is not a substitute for gold. So to be clear here, Bitcoin is a great innovation, and I'm a big fan of the space in general in terms of what it can do. I believe stablecoins, for example, are the first killer app of the decentralized finance space. But be careful of Bitcoin. It is now the case that it is economically feasible to launch an attack on the Bitcoin network. And what that means is taking over 51% of the computing power of the Bitcoin network. And it is feasible. And if you think about it, why spend billions to take over the network when you know the price of Bitcoin is going to go to zero? Well, in finance, we understand that. And what it involves is a short position in Bitcoin. Yeah. And given the derivatives markets are so deep today, it is now feasible to take a giant short and then attack the network. So there is a scenario, a credible scenario, where Bitcoin can go to zero. So that type of risk does not exist for gold. So gold, 5% of gold is used in technology. Over half is used in jewelry. It's got tangible value, and it doesn't have the same sort of network structure.
Cam, got to leave it there just because of time. It's so much to talk about. Cam Harvey, Professor Harvey, thank you so much. He is from Paul Sweeney's Duke University. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now, though, we digress. The newspapers. Here's Lisa Mateo.
Okay, this one's talking about some of the news stories you've been touching about all morning long. This one, John Tucker's been talking about the shooting at Sydney's Bondi Beach. But this story emerging from it, how the bystander who tackled one of the shooters getting praise from so many people. Local media says that his name is Ahmed El Ahmed. He's 43-year-old father of two from South Sydney. The reports say he was shot twice. He's in the hospital being treated there. But President Donald Trump at the White House, he said he saved many lives. He has great respect for him. He's also being recognized by Australian Prime Minister Anthony Albanese. And this one's kind of interesting. Pershing Square Capital Management's founder, Bill Ackman, he called him a brave hero. But what he also said is he's starting this fund to create a reward program for people who carried out similar acts. So on X, he said, as a society, we don't take care of enough of our heroes in our community. So he said he's going to report back once this program gets up and started. But there's a GoFundMe page for this person. More than $800,000 have been set up there. The biggest donor is William Ackman. It has the name there, who just gave under $100,000 for that. So a lot of praise going to this bystander.
Very good. What do you have next?
Okay, so this one is a shift in the way we listen to music. Apparently, we've heard about vinyl, right? More people going to vinyl. But apparently there's a growing trend of people, particularly Gen Z and collectors, looking to own DVDs and CDs. I threw them out.
Yeah.
I sold them at garage sales. I don't know. But
I
the Wall
do.
Street,
It's baloney nostalgia. Trust
That's
me.
what it is. Yes,
I learned it the
you
hard
nailed
way.
it. Yeah, it's the vintage media. That's what Gen Z is looking for. They say they can better support their artists, but they say they want to ditch the pricey streaming. They say streaming is costing too much, so they'd rather hold on to like $3 or $5 CDs or DVDs.
I am in awe of Tidal. I use Tidal exclusively. It sounds exquisite, and the fee is like nothing compared to the access to music. And to me, it's just to fossils. It's streaming. It's amazing, Paul.
Yeah, absolutely.
I found the Duke fight song within like 30 seconds.
Yep.
Next. They're hoping they've grown value too. Maybe they're hoping that it's going to cost be a value someday. Okay, so what is on your playlist? Have you been listening to Christmas music yet lately?
Yeah.
No?
I mean, after my birthday, I go.
Yeah.
After my birthday, I go.
That's
when you.
Yeah.
You're the one that they play.
I learned this a long time ago when I was following the radio industry.
Yeah.
The ratings for Christmas music
Phenomenal.
are through the roof.
Yes.
And so,
It's so
here
true.
in New York, it's 106.7. They go to it like
Yes.
on
How
Thanksgiving
soon?
Day or even
See,
the
Should we
that's the
play
thing.
Christmas music from now
Let's
on?
go. Here's the number one hit. Let's listen to it. There you go.
How much does she make off of this song every year, I wonder?
No, we have to look into that. She is leading the
That is
charge.
a good
Yes,
song.
of course, on top. But they're saying as of December 1st, more people start listening. Number 2 is Brenda Lee's "Rockin' Around the Christmas Tree."
Good one.
And then Wham's "Last Christmas."
That's a good one.
Oh, I love that one too. But they're saying people, in times of stress, the holiday season brings on, that's what they go to.
Wait, do you have Pantera's Christmas album?
I do not.
You don't have Pantera's
There's no
There are
such
some
thing.
great
Is
rock and
there?
roll Christmas tunes that you don't
there?
hear on the list.
Like who?
WMMR in Philadelphia, which is the greatest rock and roll station on the planet,
Okay.
they play great Christmas
The
music.
newspapers with Lisa Mateo lighting things up here on a difficult day.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.